Hello, good morning, and we're presenting Churchill Tax Advisors' weekly tax update, where we go through cases that have been announced by the tribunal and some of the cases that we have won recently. The first case that I will talk about today is the case that we have won. It was an application by our firm to the HMRC's technical team on behalf of a client in relation to a special relief called dependent relative relief. Effectively, the client had purchased a property in 1988 for his mother to live in, and he wasn't living in that property. The mother lived in that property for roughly 20 years before she passed away. The client subsequently sold the property. It was rented for a while, then he sold the property, and the property had gone 10 times higher, or maybe 15 times higher in value over the last 20 years. The capital gains on that property was going to be significant. The tax, therefore, was going to be significant. The client came to us for advice, and I spotted this opportunity. There was a special relief that had been announced by HMRC many years ago, whereby if a property is purchased for a dependent relative before 6th of April 1988, and the dependent relative lives in there, that will qualify for full exemption from capital gains tax relief. Luckily, in this case, the property was purchased on 31st of March 1988, roughly 6 days before, and the mother moved into that property. So I spotted that opportunity and effectively wrote to the HMRC for a full clearance. HMRC took roughly 6 months to respond to this clearance, because I'm sure they looked for every possible way of not to allow this relief, but the legislation was clear. Our clearance was very clear, and they ultimately agreed that yes, you're absolutely right, and there's no tax to be paid, which the client was absolutely amused, amazed at the result, because he saved over £350,000 in tax just by this special relief. So it's quite a big significant victory, so a significant success for our firm. Now we will move on to some of the cases that have been announced by decisions that have been announced by the first tier tax tribunal. The first is that of the First Choice Recruitment Limited, where appellant applied for costs. The summary of the case is that HMRC alleged fraud against a company. The company appealed. The company said, no, we haven't done it. There's been no fraud on our behalf, and the matter went to the tribunal. Now, they had a good barrister, they had a good representative. HMRC ultimately kind of felt that they had made a mistake by alleging fraud, and they couldn't substantiate it because there was no evidence provided to substantiate the allegations of fraud. The barrister, HMRC's barrister, ultimately pulled out of the hearing just before the hearing date. So the appellant, the First Choice Recruitment Company, applied for costs, and the judge allowed those costs because, firstly, they made a wrong allegation. There was no evidence available, and they pulled out of the hearing just before the date of the hearing, and therefore they had to pay costs. Very, very important case. For other fraud cases where HMRC alleged fraud, but there is no evidence. So if they allege fraud, they have to give evidence that there is fraud. That's the most important thing. The next case is that of Zoll. This is a late filing penalties that were charged by HMRC. The appellant said the law as it is written in the legislation says that the late filing notice or the tax notice to file a tax return has to be served by an officer of HMRC. Well, these days HMRC possibly cannot send notices to deliver returns to millions and millions of people. But the law as it is states that it has to be served by a person, not a computer. Whereas in HMRC, most of these notices are being sent out by computers. So the matter went to the tribunal, and the judge said the law is clear. It has to be served by a human being, not a computer. Therefore, the return was not required to be filed, and therefore you cannot charge penalties. Now, this case has happened. This decision. This is not the first time this decision has been announced. The HMRC have lost on the same grounds many times. Now what they're saying is that actually what they're looking to changing the law, or the principle is that HMRC as a body has served the notice. It doesn't have to be a human being. So that matter is now being referred to the upper tribunal, whether it should be a human being, a real officer of HMRC, or the computer that can serve a notice to file a tax return. And we will see the results of that hearing. Now, in the case of Georgia versus HMRC, once again there was a late filing penalty, and the taxpayer appealed on the basis that they genuinely believed that their tax return had been filed. Very important case. Now, unusual, because it doesn't happen all the time, very rarely. I've never seen anything like this before, but it's just the principle behind it. Now, in this case, the accountant for the appellant, or the taxpayer, filed the tax return through the online system. HMRC gave them a filing reference. So this is your reference for your return has been received. This is the filing reference. But HMRC's system did not actually receive the return. HMRC say that even if we give you a reference, doesn't mean we've actually received your tax return until it's been received. So that's why the matter went to court. And the judge's decision was it's not relevant whether the HMRC gave them a reference or not. It's whether the appellant genuinely believed that the tax return had been filed or not. So, and it was his belief that there was no doubt, there was beyond reasonable doubt, he believed that the return had been filed, and therefore the appeal was allowed. Now, just compare and contrast that with another case where somebody says, actually, I asked my accountant to do it, he didn't do it. Well, what was your basis for believing that he had done it? And that's a very important decision. The next case is, the last case for today, is SIA Kurs. It's an ECJ, European Court of Justice decision, where HMRC had denied input VAT tax for a company, and there was a tax avoidance scheme involved. However, just because there was a tax avoidance scheme involved, the tax authority could not withhold input tax because there was no advantage gained by recovering or losing that input tax by the company. So unless there's a clear advantage had been gained by the company by using that scheme in relation to input tax, you cannot deny input tax. Okay, that's it for today. If you do like our weekly updates, please subscribe to our channel or like on our channel. Thank you very much.